In this video, I want to start talking about deferred tax because this is one of the most complicated topics in the CFA Level 1 curriculum. Lots of candidates have problems with deferred tax and the intuition behind it. I've decided to create a series of videos on the topic, which will gradually take us through the entire topic, especially the logic behind it. So if this is something you want to get right in the exam, do keep watching not only this video, but the entire series, and let's get solving. On the 1st of January 2022, Incredible Corporation took out a €1 million bank loan with principal and interest of 5% per annum, repayable in full on the 1st of January 2023. For tax purposes, interest is recognized as a tax-deductible expense on a cash basis, implying that we will be able to make a deduction from our tax base for this interest expense only when that interest is actually physically paid, i.e. on the 1st of January 2023. For the year ended 31st of December 2022, Incredible reported €200,000 in earnings before interest and tax. These earnings are fully taxable at a rate of 30%. What is the tax expense reported by Incredible in its 2022 income statement, and what is the company's effective tax rate? Okay, as I said, I'm going to treat this question as the basis for a whole series of videos. So this question, even though we'll solve it in this current recording, I will have at least one follow-on recording also based on the question, on the same question, where we will no longer be realistically solving it because it will have already been solved. And then there will be additional videos where the scenario will be different, but we'll still be going through the logic and intuition behind the concept of deferred tax. Okay, let me start by saying that when we measure a company's financial performance, what we are essentially doing is one of two things, or there is maybe, to put it better, more than one way to measure financial performance. One way to measure financial performance is to produce what we call the income statement or the profit and loss account. And obviously, the income statement is going to be a key feature of financial statements. And these are going to be addressed primarily to shareholders. Shareholders are the ones who mainly, obviously, there's lots of various groups of interest who are interested in the income statement and what that income statement ultimately portrays or illustrates or shows. And that is our earnings for the company. And obviously, we have different measures of earnings. There's net income, that's earnings after tax, but also earnings before tax, which is a line that you're going to see in practically every set of financial statements, every income statement. And that is obviously then deducted from it. We've got the tax expense, and that leads us to net income. But before net income, there is earnings before tax. And the computation of this is going to follow, obviously, the relevant rules, be it IFRS, if a company is applying International Financial Reporting Standards, or perhaps US GAAP, if they're operating in North America. However, in parallel to this, most companies will also be producing an alternative measure of performance, namely one which is displayed in the company's tax filing or tax return. And the addressees of this are not the shareholders as such, it's the tax authorities, the tax office authorities, who will be interested in this. And the relevant measure of performance, which serves as the basis for the computation of the tax expense, is going to be something called taxable income. And it's on the basis of this taxable income that we can compute the amount of corporate income tax that a company should be paying. Now, critically, the computation of this follows not IFRS or US GAAP. It follows local tax rules concerning corporate income tax computation. And because tax rules are not the same as financial reporting rules, IFRS or US GAAP, then also it follows that earnings before tax are absolutely not going to be the same thing as taxable income computed in accordance with these tax rules. And from this stems a big problem, the solution of which, or the illustration of which, is deferred tax. So when we solve this question, please bear in mind this concept of things being different in the two different sets of reports. The tax filing following different rules and the income statement following different rules as well. So let's tackle the question, bearing in mind what we just said about the different ways to measure performance. When it comes to the year 2022 and this company, Incredible Corporation's 2022 financial performance, I'm going to split it into two different measures. Measures which are portrayed in the income statement, and that's part of the financial statements done under IFRS or US GAAP. And over here, I'm going to have the tax filing or the tax return for the company, this in accordance with tax rules. And one of the pieces of information, it's over here in the second paragraph. It says, for the year ended 31st of December 2022, Incredible reported 200,000 in earnings before interest and tax. So let me put this down as the EBIT of the company here, or operating profit. It also says that these earnings are fully taxable at a rate of 30%. So this number, 200,000 is the EBIT, but it's also the taxable income for the company. This doesn't realistically happen in real life for reasons of certain expenses not being necessarily tax deductible in the same period as they show up in the income statement. But taxable income in this hypothetical scenario is 200,000 as well. Now, this is EBIT, so it's before interest and obviously before taxes. And we've got to consider the fact that in the income statement, I'm still going to have the line interest expense or finance costs. Interest expense. In respect of the year 2022, the company, from the very first day of the year, it had this €1 million bank loan. And even though the bank loan is repayable on the 1st of January 2023, together with the interest accrued on it, and it's simple, 5% of 1 million is simply going to be €50,000. From an accruals basis, from a matching basis perspective, matching concept perspective, even though the expense as such is suffered in 2023 as a cash outflow on the first day of 2023, it actually belongs to the year 2022. So it should be shown in the income statement of 2022. It belongs here because that's when, in 2022, for the entire duration of the year, the company was using somebody else's money for which they have to pay interest. And even though the payment itself happens next year, the expense as such belongs here. So I'm going to say interest expense 50 belonging to the income statement of 2022. Now, this leads me to conclude that earnings before tax, so after the interest expense, but earnings before tax, so already including the interest component, which is a negative, are going to be 150,000. On the other hand, no such line, interest expense, will appear in the tax return. The reason for this is that from a tax perspective, interest is recognized as a tax-deductible expense on a cash basis, so only when it is paid or in the period when it is paid, not 2022, but 2023. So in my tax return, I'm going to have taxable income stopping at 200,000, and therefore the income tax payable in respect of the year 2022 to the tax office is going to simply be this, in no way adjusted for any interest expenses, times the tax rate, which is, where is it here? Okay, it's here, 30%. so times 30%. 200,000 times 30% is going to be 60, and that's how much the company will have to pay in tax over to the tax office or the tax authorities. However, we now come to a very important moment over here in the income statement, because I've already got my EBT, earnings before tax. And, what you may also find is that this is also known as, or also described as, pre-tax profit, pre-tax earnings, or even accounting profit. However, the critical thing is that we now must introduce the line tax expense or income tax expense, because this is what separates us, obviously, from net income, which is after tax. The thing that many people get wrong and wrongly assume is that the amount of income tax shown here is simply whatever is the income tax that we pay to the tax office in respect of the current period, which would lead us to conclude that it's an amount of 60. Now, in reality, the 60 is an element or part of the entire computation, but it's by no means the only component. There's also something else. The tax which you pay to the tax office or have to pay to the tax office in respect of the current period has its place here. It's called current tax. However, there is an additional component that we will now explore, and it's called, well, you guessed it, deferred tax. And it's this deferred tax component which we're going to identify, which causes a lot of trouble for financial analysts or aspiring financial analysts. Now, what is this all about? Let me explain by drawing a timeline. Okay, I'm going to illustrate the concept of deferred tax by drawing a timeline. On this timeline, I'm going to label several moments. First of all, I'm going to have the 1st of January 2022, then the 31st of December 2022. So this over here is the entire year 2022. And obviously, next to that, I'm going to have, maybe here, 1st of Jan 2023. And that obviously is then the year 2023. What we can do on the timeline is label several important moments. First of all, over here, the loan being taken out. So loan taken out. And let me recall that the loan was for an amount of €1 million. The loan was being repaid over here on the 1st of January next year. So maybe an arrow pointing to this moment on the timeline. This is the loan repayment, and the loan repayment obviously incorporates the 1 million, but also interest. So the cost of using somebody else's money. This interest was computed at 5% of 1 million. So times 5%, and we already identified this as being €50,000 of interest. However, what you've got to absolutely bear in mind, that even though the 50,000 is paid over here, so in the year 2023 technically, it still represents an expense or a cost for using somebody else's funds, where the usage of those funds, the borrowed money, occurred pretty much in the year 2022. So even though this on a cash basis happens here, from an accruals basis or a matching concept basis, it belongs to the year 2022. That's why we're going to, or we did, include the 50,000 as an expense belonging to the year 2022 income statement as a cost over here. And now the leap into deferred tax. When the company makes the payment of interest in 2023, that will have tax consequences. Because when it does its tax return for the year 2023, not 2022, the next year, this 50,000 will be included as an element which reduces taxable income. Taxable income will therefore be lower because of the payment of interest. And the company will make a tax saving on that because it becomes a tax-deductible expense. So this will cause tax consequences, but positive tax consequences, in the form of a, 50,000 deduction times 30%. So times 30%, that's going to give us 15,000 of positive tax consequences, or we could say tax saving. And if you've studied your corporate issuers section of the curriculum, formerly known as corporate finance, you will, recall this effect as being the so-called tax shield associated with debt financing, the fact that interest is tax deductible, although in many, many countries, it is deductible on a cash basis, meaning you can only reduce your taxable income because of paying interest when you actually physically pay it, like here in January 2023. Now, the whole idea, the whole concept is as follows. If we came to the conclusion that the 50,000 of interest payment belongs to the income statement of 2022 because it's associated with the usage of funds over the course of the year 2022, and it kind of realistically on a fair basis belongs here, we should absolutely try and be consistent. And also in the same income statement include the side effect of that payment, which is the tax saving, because it wouldn't really make sense, or it wouldn't really be fair to include just one aspect of it, the cost of 50,000 in the income statement of 2022, if you don't do the same thing to the tax saving, which is a direct consequence of it. So what we therefore do is we accelerate the recognition of the interest expense into the 2022 income statement, but we also try to accelerate the positive side effect of this, which is the tax saving that we're looking forward to in 2023, and that goes into the line deferred tax, because as a consequence of in the future paying this interest 50,000, we're going to make a tax saving, or we expect to make a tax saving. The deferred tax element will be a 15,000 negative, in my case, negative because it offsets, at least partially, what is otherwise a tax expense. That's how I'm showing a positive impact within an expense line. And I come to the conclusion that as a result of paying interest in the future, I'm going to make a tax saving. So realistically, my income tax expense shouldn't be this big. It's going to be just 45,000 on a net basis, even though I'm actually paying 60,000 to the tax office. And therefore, ultimately, my net profit or my net income is 60 minus 15, 45,000 tax expense. And over here we had earnings before tax 150, deduct 45 from this, and we get 105,000 of net profit from that computation. Now, please note that the income tax expense doesn't necessarily reflect how much was paid to the tax authorities. It is a component of the computation, but it also takes into account already a future tax saving, which we are looking forward to making. Now, what is therefore going to be the answer to the question? Looking at the possible answers to the question, we've got a reported tax expense of 45,000. So it's either going to be answer A or C. How about the second component, which is going to really differentiate between the right and wrong answer? Well, we need to still compute what's known as the effective tax rate. And the effective tax rate is quite a simple concept. You shouldn't be afraid of it if you get it in the exam. This is simply taking the reported tax expense for the period and relating it to the earnings before tax, the EBT. So in our case, the reported tax expense is the 45,000 because we're taking this from the income statement. This is purely an income statement-based measure, nothing to do with the tax return. So 45,000 of reported tax expense, but related to the earnings before tax, which was 150,000. And let's have a look on my calculator over here on the phone. I'm not going to necessarily display the calculator because it's such an easy computation to be doing. 0.3 or 30%. As a result of doing this deferred tax adjustment, let's call it, we have made the income tax expense equal to 30%, the statutory tax rate of earnings before tax. That's the effect. So picking the correct answer from the list, it will obviously be answer C. Now, I'm not leaving this scenario yet. In the next question, I'll talk to you about how this is recorded in the financial statements and what the follow-on consequences of this deferred tax are going to be when we look at it from a subsequent year perspective.